Good morning and welcome to the ANIMALCARE Group PLC full year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd just like to submit the following poll. And I'd now like to hand you over to Jenny Winter, CEO. Good morning.
Good morning, and you're very welcome to. This is the first time we've done one of these, so I'm hopeful that we hit the mark. But if not, please do, as you've been instructed, to add some questions. So I'm Jenny Winter, and you can also see Chris. Chris and I will manage this between us, and hopefully cover off all the areas that you're particularly interested in. So Chris is moving the slides. So if we go to slide 3, that's it. I know that many of you are familiar with ANIMALCARE, but some of you may not. So we've just popped a slide in just to enable us to give a bit of introduction so that you can get to know us a bit better. So we are listed on AIM. We're predominantly, we're an international business. We're a veterinary sales and marketing organisation. We also bring new and innovative products to market through R&D, including our own development team, but also we set up partnerships and we in-license products from other parties. We operate directly, and what we mean there when we talk about our direct markets, that's where we have our own sales and marketing operations, and we operate in 7 countries. So clearly in the UK, Belgium, Netherlands, Germany, Italy, Portugal, Spain. Hopefully I've not forgotten anybody there. But we also run what we call international partners, and that's effectively our export business. And on the whole, that export business is exporting businesses to those countries where we don't have our own sales and marketing team. Occasionally, we also have a distributor in a market where, for whatever reason, it's not appropriate or it's not relevant or it doesn't make any sense for us to sell a product. But mostly those international markets are where we don't have a sales and marketing operation. Okay. Just another point in terms of summary. Those of you who follow animal health will know that it really splits into 3 segments. We're going to talk about those segments: companion animal, production animal, and equine. Our northern European countries just have companion animal and equine, as southern European countries have companion animal, production animal, and equine. So just a slightly different, for historical reasons. Happy to explain those if you're interested. So just in terms of, what we see as our summary, we're a profitable, cash-generating business, got healthy margins, got strong cash resources, and the financial firepower to do some growth, M&A growth. And you'll hear that as a theme coming through. On the next slide, we talk about what our strategic priorities are. And in effect, what we're doing is focused on organic growth. Organic growth we talk about as any product that is already launched and in our portfolio. Inorganic growth, we're going to talk a little bit more about that, but that's driving mergers, acquisitions, and in-licensing. So external opportunities that we can either put into the purple box into our new product pipeline or put into our existing sales and marketing operations. So the underpin for those 3 strategic pillars: strong finances, a good team in place, and operational excellence. And those for us are really important to enable us to do those 3 boxes on the top. Just sharing a little bit about the highlights in that same structure. I'm going to talk additionally through the presentation about 3 things that have actually happened post the year end 2023, all of which have been announced, obviously. But these are mostly the highlights from 23. We have a dental product called Plaqtiv, which is growing really healthily. It's only been launched. This will be its 2nd full year. Did really well in 23. Daxocox is a product that we have. We own the intellectual property. It's a once weekly non-steroidal, and that's also growing healthily, predominantly in our markets where we have direct sales and marketing operations. And our equine portfolio benefited in 23 because we did have a product in the UK that was on distribution by somebody else. We brought that into our pipeline, into our portfolio, And of course, we've seen the benefit of the sales and the margin. We're going to talk about all those in a little bit more detail. In terms of inorganic growth, we're really focused on finding those good external opportunities, partnering, M&A. But we're also very disciplined about what we bring in. So we're very careful about what we do. I referred to some things that had happened after the end of 23. The next bullet point on that blue slide is one of these. We disposed of our ANIMALCARE business in February this year. So it's a post-year event. And really, we'll talk about that, but it was absolutely part of our strategy as it was non-core to the rest of the business, but has given us some great firepower. In terms of new product development, a couple of years ago, we did a deal with a Dutch company, Orthros Medical, who have some really nice antibody assets. And they're very early in the pipeline. So we're gently nurturing those through. And if they come to fruition, there'll be great transformational growth, but not until sort of the 27 timeline. Okay. The second of the two post-year end events that we'll talk about in a bit more detail is we sold our equity stake in our joint venture, which was called STEM, and we'll come on to that. That gives us a bit more firepower. So in terms of the strong finances, they are really strong now. And so we're very excited about what that will enable us to do. In terms of people, we've got a great team. We're about 220 people. About 60% of those are customer facing. So this business has sales teams who go out and call on individual vets, and that's the business model. It's the most successful model. It's the same as everybody else in this business. So about 60% of our team are customer facing. The other big groups are people in R&D and the technical area, which is a really important piece of the business. Most of our products, about 75, 80% of our products are prescription only. So that means the vet has to write the prescription, and then the vet either dispenses the prescription or it goes through a very formal logistics flow, because everybody has to be licensed in that chain. Okay. In terms of people, the third event that we announced after year close was a change in chair. Historically, our chair, or in fact still until the AGM, our chair is a guy called Jan Boon, who runs and owns a lot of Lotus Bakeries, a very successful Belgian company. And Jan has been a great chair. He's been hugely supportive, but after 7 years, he felt his time had come to move, particularly because of that blue box where whenever you're doing M&A and acquisitions, the chair needs a bit more time. And so Ed Torr has now taken over as chair. Ed has got a great history in animal health with DECRA. And even in the last couple of weeks, when Ed has simply been chairman-elect, we've noticed that he's inputting a lot to help that blue box. So we're pleased. Jan was great. I'm sure Ed's going to be great too. Operational excellence, because of the way that we manufacture with third parties, and then the way that our logistics framework works and the regulations around its supply chain is really important for us, both in terms of inventory, working capital, but also in demand management. Demand tends to be driven by the wholesaler ordering pattern in most of our businesses. And in international partners, so our export business, it tends to be quite bumpy because our export partners buy large amounts at once. And so you'll hear a bit of a theme about that not being very predictable. And it makes a big difference if somebody buys in a December, because they might not buy for the whole of the next year. So you see some lumps. And so we've brought in a really superb supply chain leader who's ex-Colgate, ex-GSK OTC. And so that will really help us in terms of the operational effectiveness. Okay. Just on the next slide, one of the things we struggle with is getting accurate data about whether the market's growing, declining, and we see all sorts of numbers floating around. And so these are just the best guess at the time that we were putting the presentation together. The animal health market is still showing growth. If you look at the different segments within animal health, there's some bumps. So where we see most of that growth coming from is pharmaceutical prescription products, that are more novel and work in a in a more sustainable way. So different products that are coming and maybe changing the effectiveness, changing the safety, changing the formulation. So we see the growth in the market in that area. We also know that there's continued high levels of pet ownership. We see headlines about, pets being rehomed, but we don't see that coming through in the number of pets. There's definitely fewer puppies than there were during lockdown, but now we're starting to see the increase as the puppies age and they need medication. Okay, we see that individuals are spending more on their pets. They're more humanized, and you only need to wander into some of the pet stores and see what people are buying. But pets are becoming a big part of household spend. I mentioned the point about novel. One of the things we do see is a growing influence of veterinary corporates. That's particularly in the UK. And those of you who have seen that the CMA is deciding whether or not to hold a full inquiry into this area may have some questions about that. Where we are on that is that we see it mostly focused on the corporate ownership of vet practices. We work with corporates, we work with the independents, but we see most of that CMA review looking at the veterinary corporates. What we do is if our cost of goods increases, we think very carefully before we pass any of that on. And so we believe that the manufacturer's prices into that business are very competitive, and we will obviously participate in the review if required. But at the moment, we don't see it as we see it as neutral for us. The other point, and we'll talk more about M&A in a minute, is we're feeling and seeing more of an appetite for M&A than we have probably in 21, 22. So we're starting to feel that come through. Okay. Because this is our year-end results, Chris is now going to talk about the highlights of our financials.
Morning, everyone. Just on the financials, I've got a couple of summary slides. Then what we'll do on revenue in particular is I'll cover that in each of the three product categories that Jenny talked about earlier, which was companion animal, production animal, and equine. So I'll just use this slide to kind of summarise last year, if that's okay. From our perspective, we're really pleased with the financial performance last year. We saw a return to revenue growth following a particularly strong second half. Continued progression on gross margins, so they've improved probably year on year for the last 5 years. I'll come on to some of the drivers of that. Underlying cash conversion, this is operating cash conversion, the firepower that we need to invest in research and development. So that improved year on year. And what you can see on the right hand side is our kind of net debt cash. So at the end of the year, excluding IFRS 16 leases, we're into a net cash position. Jenny's talked about a couple of transformational things post year end, being the sale of Identicare and then the sale of our equity in STEM on Friday. I think we had a question submitted before the presentation about how much cash we have on our balance sheet now. So it's about 30 million as of today. So we've got a really large amount of firepower that we're going to deploy to execute the strategy. And I've got a slide later on capital allocation. On EPS, I don't go into any more detail later on. This is really a story of tax, the exciting area of tax. So if you look at our EBITDA, that's slightly up. Operating profit and profit before tax are about the same as last year. So this is on tax and it's deferred tax. And very simply, so we recognise some tax losses last year where there's a credit to the P&L, and then we've utilised those this year, so you lose that benefit. So you'll see it's mostly deferred tax. I'll come on to the bottom, what dividend I'll come on to later when we look at capital allocation, but the headline there is that we've increased the final dividend to 3 pence. So it's companion animals to start with. So this is the biggest area of our business. It's about 70% of turnover. So that grew by about 4%. Just touching on some of the drivers, it picks up some of the brands that Jenny's talked about. So our dental portfolio grew really well. So Plactive, which is the range of products that come out of the STEM JV for a license, so that stays the same. So the equity sale doesn't impact on this. That grew really well by about 1 million because it was launched last year, and it also pulled along some of our other dental products. And now our largest brand is one of our really long-established dental products called Orozyme, which is an enzymatic toothpaste. So really pleased with the dental range. We'll continue to drive that forward. We've got some new product development coming on that side. Daxocox grew really well in our own operations. I'll come on to a bit more the investment that we've made in the business. So Jenny's talked about operational excellence, but we've definitely invested in sales and marketing excellence in 23. That'll be a theme in 24. And what we can really see is when we put focus on that, we can really start to see the fruits of that through the revenue line on growth. ANIMALCARE, which was the business we sold, so this is the microchipping and subscriptions-based business. That's in here. That grew by around 30%, so had a really good year with subscription growth. Obviously, that's out from 24, but again, we're really pleased with the way that business performed, and obviously that's reflected in the valuation that we achieved for that. Inevitably, there's always lots of positives in a year, but there's some things that kind of, sometimes kind of hit the business. Key one on there, kind of linked. So there's a couple of things. One is we have a generic portfolio. Typical with most of the animal health companies, it's probably about 75%. So there's always some ups and downs on some pricing, competitive behavior, etc. But they're the things that we deal with. I think coupled with the recruitment of the supply chain director, we did see some disruption later on in 23, and this was really centered around a manufacturing transfer of a range of products in the UK. So we saw a few teething issues with that transfer of manufacture, but we're through that now. So supply is back to normal in 24. On production animals, as Jenny said, so this sits in our South European operations, so Spain, Portugal and Italy. And we also sell some brands through our international partner network. And international partners is our export part of our business. So direct sales through 7 operations, and then we sell to different countries across the world. You can see revenue there is broadly flat, but 2 very different dynamics between our internal operations and the export partner operations. So our internal operations grew by around 10%, particularly strong growth in Spain. Couple of reasons. One is that we launched a new distribution product. We'll come on to the definition of that, but they're sourced from partners, and that did really, really well in the year. That was launched in the year, and we'll see growth through that. And also there was certain core brands across the portfolio that grew in the year. Little bit of return to antibiotic sales, which kind of from 21 to 22 dropped off to almost zero. And under legislation, there was never meant to be kind of zero usage, so we've seen some come around on that. So really pleased with the way our internal operations are going. On the international partners, so this is obviously down year on year, and a couple of reasons for that. One is when we sell to customers, it might be one sale a year of a big batch, so they typically take a full batch. So this particular one was where we sold quite a big lot of sales to New Zealand, and that was in December 22, and there was no order in 23. So we do see some kind of choppiness in terms of phasing of orders, and we note there some generic competition. That was against one of our key brands, notably in Germany, where there was a competitor launch, and they went in at a much lower price than us. So we've responded through some pricing measures. Not to the extent of the competitor, but we have lost some volume there. So overall, small amount of growth there, and that directionally is kind of strategically we're saying under that how we see the segment. We want to maintain that really important part of our business. It's profitable at gross margin. It's profitable at EBITDA margin. It generates good levels of cash, which we need to fund the pipeline. So the strategic goal there is to at least maintain that sales of that roughly 16 million mark. On equine, this is a small but growing part of the portfolio. Strategically, I think we'll come on to greater focus we feel on this going forward. I think there's some opportunities there. The story here is Danilon. So Danilon is a very strong brand in the equine market, and that grew by so the overall portfolio here grew by 11%. Danilon was a lot higher than that. And the reason for that is we brought that back into our own sales and marketing control during 22. So that used to be distributed in the UK by Elanco. And as we brought that back in, so two things. One is our sales and marketing focus is a key brand for us. It's our top 5 brand, one of our top 5 brands. So that drove the sales. And then secondly, a little bit linked to the margin evolution. When you bring those back in, then you obviously gain the margin that the distributor used to make. So two good things there. And as I said, we'll continue to focus on this area going forward.
I just wanted to take the opportunity to highlight 2 of our key brands that will be growth drivers for the future. On the left, you have Daxocox. This is a product of our own that came out of a business that we bought a few years ago in 2015-16. It's a once weekly non-steroidal for dogs with osteoarthritis. And it's a great product. I think we always say that we over anticipated how well it would do at launch for a number of reasons, predominantly that we launched it at the same time as we had COVID lockdown. And one of the things we know is that for vets to change their behavior in a therapy area where they've been using the same product for many years, that in order to do that, they need confidence and they need to see their rep and they need to understand the product. So we believe we've addressed those things now. This is a growing segment of the market, dogs with OA as dogs age. There are some good treatments out there. The benefit of this is it makes life easier for the pet, for the vet owner, and also for the vet, because it's once weekly. It's a tablet once weekly. So this is a lovely product. Our reps are now fully engaged behind it, and it's a really big focus of us moving forwards. A couple of other things that we're doing in terms of longer term. At the moment, this product has a license only in osteoarthritis. A lot of the competitors have broader licenses, and so we're now going through the process of broadening the license. I think the first 2 indications will be launched in 2025. Also doing some work on making sure that we have the right dose forms and formulation. So that's an interesting and exciting opportunity. We are also expanding the number of territories. At the moment, it's launched around Europe. It has a European regulatory file, and we're currently applying for or going through the process for another 10 countries to get a regulatory file. In countries where we don't have our own sales and marketing operation, this product is sold by Virbac. And so we're excited about seeing what Virbac can do as we move forwards into the rest of the world. Plactive, as Chris and I both said, this is the product that came out of the STEM joint venture. And it's a great product. Our reps love selling this product. It's a growing area. The vets are really interested because of the link between dental disease and other healthcare conditions. Clearly, their pet owners are very interested because it helps solve a problem for them, and hopefully the pets like it too. It's a rapidly growing segment. We're very competitive. One of the things that people like about this is there's a range of different products, as you can see on the little slide here. We're continuing to do some new product development, and we have distributions agreements in countries where we don't operate with some really big players. So we're very excited about expanding the Plactive products outside of Europe. So these are 2 really important drivers for us. Okay. Just a couple of words about the portfolio. Anybody who's been following us for a while will know that during 2019, we focused very much on reducing the number of tail products we have. So products without the sort of margin that we like to have. And now we've got a good portfolio that matches, if you look at that little left schematic, as the pet ages, then obviously more things happen to them. We don't operate in that broad vaccine parasitology area, but our products are shown on the lower of those two schematics. And you can see that we operate in that area where, increasing lifetime value, increasing chronic conditions. And so we now look at our portfolio and see that it's very well adapted to where the growth is coming from in this market. So we're very confident about that. One of the questions that we have had historically, and Chris talked about distribution. And when we first started the journey in 2019 to really make the portfolio better, we had a lot of distribution products and we lumped them all together as distribution products. What's really clear now is there are good distribution products and not so good distribution products. And the criteria for those two groups, good distribution products are ones that have a good margin, have good growth, have long-term agreements and really robust agreements, and also that they are in several of our markets. The ones that we got rid of were predominantly very low margin and also some where the contract was not great. So the originator took it back, etc. So we now are very confident that the distribution products we have are in that good distribution product. So, there's two questions: the quantity of distribution products, which is now lower than 40%. It was higher than 50% when we started, but more importantly, the quality of those contracts. So that quality is improving, the quantity is going down. Okay, so we've got about 150 brands at the moment. Is that the right or wrong number? It's really hard to tell. What we do is constantly look at the smaller products, the tail products, and take those off as we have more of a focus on the top brands that continue to grow. So the quality is continuing to evolve and strengthen, which is great. We've talked a little bit about Identicare, and I just wanted to use this opportunity to just position what we did. In 21, we took a decision to carve out Identicare. And that was really strategically because we recognized it was a non-core asset. Whilst it operates in healthcare, it's really a reunification business based on the microchip and using the database as a subscription-based business. And Chris and I realized that that wasn't our background and experience, that it needed a different lens around it. And we brought in a gentleman called Robert Diamond, who has experience of digital specialist businesses. And he came into the business in early 22. And the business is fundamentally changed now. It's really robust. It's subscription-based. It's a great business. What happened in 23 was we started talking about it a bit more because it was a good business and it was a really important part of our business. And what that did was generate some inbound and interest, particularly from private equity, which we'd always thought that we might sell the Identicare business as a unit. We'd probably thought in a couple of years' time, but we'd sort of set ourselves a target for what we thought we should realize. And in 23, we ran a short process and realized that target. And I think Identicare has gone to a good home. It will, I'm sure, continue to grow under the leadership of Robert Diamond. And what that 24.9 million that we got will really help us to drive our future growth in the core of our business of prescription medicines for vets. Okay.
Okay, so I'll just do a run through on the cash side of the financials. I am going to focus on the top right, and I'll touch on that on the bottom one. So if you just look at cash conversion, so as I said early on, we targeted to improve on year on year, and we delivered that. So there's around 1 million more what we call underlying net cash flow from operations. You can see some of that's through working capital. And also some around the non-underlying cash items. In terms of direction of travel, so again, we're targeting to improve on the 23 performance. So we set ourselves a target of 90% cash conversion this year. Touching a little bit on what Jenny mentioned earlier around operational excellence supply chain. So we see some opportunities there, particularly around smoothing out some of the cash generation from our stock holdings. So 90% target for this year. And then secondly, phasing. For those that have seen the kind of history, we tend to have a very a lower cash conversion in the first half versus second half. We expect that again to happen in 24. Candidly, the business and I really want to kind of try and smooth that out during the year, so we kind of don't see this, the kind of hockey stick. So that's the focus of that, particularly around supply chain. But so targeting again to improve. The bottom bridge just kind of shows where we started and ended the year in terms of kind of net debt. So this has got IFRS 16 in. You can see the theme of net capital expenditure. So linking to the portfolio. So most of that expenditure tends to be on R&D, and we'll come on to that a bit more detail with Orthros. And then also we've invested a lot in the past kind of 3-4 years in our IT infrastructure. We're probably up to 2.5-3 million. So this is making sure that we've got common systems, common platforms across the whole business. We've got SAP everywhere. We've got Viva, which is our kind of CRM system. So again, we're continuing to invest in that area in 23, and a little bit of a drop off in 24, but really wanting to have that what we call strong platform in terms of all those systems that really give the business information to make on time to make key decisions as we move forward. On the bottom bullet in bold on the revolving credit facility. So our current banking facilities mature on 31st of March 25, so next year. And as we said in the public domain, we're renewing those now. We have two facilities, a revolving credit facility and an acquisition facility. We will renew the revolving credit facility broadly on the same kind of level that we've got now. The acquisition line we're going to let fall away, albeit conversations with the banks last year when we were looking at some M&A targets. We know it will be there if we need to. So our syndicate of 4 banks are really supportive of our strategy. But because we've got the cash in the bank now, then the view was that that facility is not required at the moment.
Okay.
Sorry.
I have to speak really quickly to fit it in with the slide. So just moving on to talk a little bit about how the business is going to grow in the future. What we've done here is a schematic of the areas that we're particularly looking at, and we'll talk in a little bit more detail about BD and M&A on the next slide. So clearly our organic growth is really important. When you look at Daxocox and Plaqtiv, both of which are really high margin products, the more dominant those products become in our portfolio, we'll continue to see margin improvement, and we'll see that revenue growth from Plaqtiv and Daxocox. Within the rest of the portfolio, there are also some really good products. I think Chris mentioned Orozyme, which is growing at double digit, and despite being about 20 years old. So the organic growth will come from that, and we'll focus on making sure that revenue, margin, etc., is being driven there. In organic growth, there's roughly 3 areas that we're looking at. We recognise that we have businesses in 7 markets. Chris has already talked about where we have our own sales force. Danilon's a good example. Daxocox is another good example. When we have our own sales forces, we know we do a good job. And we also know that there are some areas of the globe that we are not currently present in, but importantly, there are some areas in France. So clearly, if you look at our map, we're not present in France, we're not present in Eastern Europe, we're not present in Scandinavia. And actually, in some of our countries, we're slightly subscale. Spain is definitely at scale. It's probably number 7 in the ranking in businesses there. It's a good business with the right scale. Probably Germany and Italy and the UK, we're looking at bolt-ons to just create some more scale. We're looking to see whether we can put an operation in France. The French business is for 2 reasons. One is obviously it's a big veterinary pharmaceutical market, so it's an important market in Europe. But also when we're doing the next stage, the next blue box, in licensing late stage assets, one of the questions we're always asked is, well, how will you manage France? And at the moment, we manage that through distributors who we've worked with for a long time, and they're very good, but it would be we believe it would be more attractive to partners if we had a French business. So looking for that. And we're looking to acquire brands and companies. So this might be the bolt-on in Germany. It might be a product that is launched in the US, but not in Europe. It might be all of those sorts of things. So there's a lot of work going on in these three boxes. The US is a big market and it's growing healthily and always does. It's also a really tough market to penetrate on our own. So we are constantly looking at whether there's an opportunity to partner with somebody in the US, whether we could find a business around our size to go and JV. So we're always looking at that. We haven't got anything on the table at the moment. The other area, excuse me, Asia Pac, Asia Pacific, again, we recognize there's growth opportunities there, but we also recognize that we need to be careful how we go through. For an animal care company, I'm very sorry, but my dog's just decided to go and bark. So apologies for that. Living the dream with a... So she was snoring earlier. I don't know if you heard that as well. But so those are the three boxes that predominantly we're working on. We will look at the Asia, Australia. We will look at the US, but our main focus is building scale, building footprint, and in-licensing products in Europe. Couple of questions on the right-hand side on the purple boxes on new product development. At the moment, we have the Orthros portfolio, which I'm going to talk about in a minute. This is the VHH antibodies. We're not looking to in-license early stage assets until we've got more confidence about where those will end up. So at the moment, we're not very active in that area. We keep an eye on it, and we do some in-house innovative new product development, which is generally smaller products, tweaking formulations, those sorts of things. So this is how we see the growth drivers for ultimate EBITDA growth. On the next slide, we talk a little bit more about some of the specifics. We are seeing increasing openness to explore deal-making options. In particular, for a while, we've recognized, because of our scale, our big products are the sort of 4 to 5 million. Because of our scale, there are things that exist in the really big companies' portfolios that we could make really successful. Historically, they were kind of like, no, you know, that's too much hassle. We're now seeing them come forward with products that we think we could make great success of that fall out of their portfolios. We've strengthened our internal resources. We've freed myself and Chris up a bit more for getting out there, talking to people, knocking down doors, opening opportunities up. We're highly active, we're ambitious, but the word I used earlier, and I'll use again, is disciplined. We know that the deal has to be right. Strategically, it has to be immediately or very quickly revenue and EBITDA accretive. So we're very focused on that. So we're really clear. We also have, for any product, whether it's a small distribution product or small license product, we've set margins, margin criteria and revenue criteria to make sure that anything we bring doesn't add complexity or bring our margin down. So we're very clear on what we will and won't bring in to the business. So I've talked about these, strengthening the pipeline, not our big focus at the moment, but we've got the Orthros products, geographic footprint and sustainable growth. The final point on the left-hand side, happy to answer questions about the STEM deal that we announced on Friday, lost track of my days, Thursday actually. So we set out with that joint venture with Kane Biotech. We had a 33 point something share, and the equity gave us certain contractual rights. It also gave us an evergreen sort of lifelong license for the Plaqtiv products and the technology that goes into the Plaqtiv products. And so when Kane announced last year that they wanted to sell their 2/3 share, we focused on making sure that we retained some of the things that were good about that deal. And so we're very happy with the deal that we ended up with Dechra buying our equity, but we also get the license for Europe and the rest of the world outside the Americas for vets. We get that in perpetuity. We also have the rights in Europe for not only the vet, but also all the other channels, which we didn't have before. So that's good. We also have an opportunity to influence and benefit from any product development that DECRA choose to do. We also have the opportunity to do our own product development. So from our perspective, this is a great deal, and we got a superb return on the equity investment that we made, and we're really happy about that. And so that cash that we got for our equity will go into the pot to do more deals and to drive future growth. Just on the right-hand side, we've talked about velocity increased. And in the last year, as other elements of the strategy have played through, as the platform has strengthened, as margins have strengthened, we've put much more energy, time, and people into the inorganic growth portfolio. So we've screened about 450 products and companies. We've got about 40 that we've decided are of interest. Today, some of the other 450 are interesting, but maybe not for tomorrow, or they're too big for today, or they don't want to sell today, all sorts of reasons. We've got about 40 that we're following up. We've got 7 that we're in discussion. We did 3 new deals last year, and we did 1 big NBO. And although we were ultimately not able to land that one, we know from that opportunity that we were in the right ballpark. We had enough cash. We had the support of the banks, all of those good things. Ultimately, we didn't get it for reasons that we couldn't influence and that weren't in our control. So there's a lot of activity going on here. But just to reinforce that word that you're seeing on the top in the title, really disciplined about what we do. This won't be we think this might be interesting, we'll just bolt it on. It'll be really disciplined, and we have a process in place. Okay. Orthros, which is the VHH antibody-based agreement. This is a Dutch company. We did the agreement a couple of years ago. Really, really early stage, but very exciting. And actually, since we did the deal, we've seen many more competitors trying to get into this field. Originally, we were focused on just the dog indication, and that's because you can see how big the dog osteoarthritis market is, and it is a big market. It also will be a very competitive market. This year, one of the things that we've done is initiate studies in horses. And that's for a couple of reasons. One is, for us, the equine portfolio and the equine business is really, it's the right sort of size and scale. We're smaller than the big guys, but the vets who manage horses, it's a smaller group, it's a more focused group. And so for us, that's really good. Might not be such an enormous opportunity, but it's a really clear opportunity. And we know that these products should be effective. So we can never tell till we've done the studies. That's why we took the decision to go into equine as well. There is a chance, although no guarantee, that the regulatory process might be a bit quicker as well. And so what we'd like to do is get moving, really. And we'll go into dogs later in the year. Dogs will be a little bit more complicated because of the route of administration, but it's a huge market, and we're really excited. But we're also really clear that these are today, if they are in the clinic, they're only just in the clinic. So they're really preclinical. So there's a long way to go before these actually launch in 27, 28. But we have the license for 2 targets at the moment that we're working on. We also have the option to license other targets that Orthros comes up with. So Orthros, the potential is enormous. It could be cancer. It could be, any range of things. So we have the option to license those. We're not going to do that and exercise it until we know the first 2. So that's what we're doing with the antibody-based agreement. And the reason why we did this was because the later stages that drugs get to, the more expensive it is to buy into. And so we thought we'd start nurturing early. And we've also, the funding is built on that premise. So early funding's small, and it grows as you become certain of the outcome. So this is exciting, but we're really careful about it. And we'll see what happens. Back to Chris.
Thanks, Jenny. So as you can imagine, as we were going through our roadshow last week, every single meeting had the question of how are we going to spend all this money that we have? So the 30 million that we talked about earlier. So what I'll do is I'll run down the capital priorities on the left-hand side, and then, as I said earlier, we can touch on dividend while we're on this slide. The organic growth piece is actually a couple of things. So from an organic growth perspective, this is really around centering on driving that top line revenue growth. And we have a target of growing at or above market. Jenny noted that the global animal health market's growing about 5%. So that's a broad indication is that at that level or more is where we're targeting. We've covered the areas that of investment. So a lot centered around people. To give you a feel, about 2/3 of our people base is commercial. So sales, marketing, vets that are in the field, etc. So we significant investment in there, and we'll continue to do that. And the operational excellence of the sales, marketing, and supply chain. The other part of overhead investment really centers around. I think you've heard us talk about the word strong platform or strong foundations. We recognise that as we increase the velocity on inorganic growth, that comes with risk. And what we've been really focused on is making sure that we've got the breadth and depth of talent across our organisation that enables the business to continue to grow organically while we also focus on the inorganic part of the growth strategy. So inorganic growth, so these are the kind of blue blocks, the building blocks that Jenny talked about before. So it talked about debt and equity capacity here. Clearly, that's now including the cash that sits on our balance sheet. So all of that funding is for what we call accretive M&A. So this is late stage assets. It could be that some of the big pharmaceutical companies, we're starting to see some movement on tail rationalization. So there's some opportunities there for acquiring some of their products that are small, which would be large for us. Our biggest product probably in the 4 to 5 million mark. So there's some opportunities there, but really around driving revenue, profitability, so EBITDA in particular, and also generating cash. Jenny's talked about this, the word discipline. The way we apply that here is that we have a target peak leverage of 2x EBITDA, and we've had that for a number of years, and that's where we feel comfortable in terms of leveraging up. We'll come on to later on. The business has a great track record of deleveraging, so we're really comfortable with going up to 2x. Our bank covenants are 3.5x before leveraging down. If you go to the bottom part of that, where it's talking about funding capacities, how much money do we feel is available? This was prior to the STEM transaction on Friday, which I think added another 3 million-ish to the balance sheet. So that 50 million comes from 2x the pharma business EBITDA for 23. So Identicare was 1.7 of the 13.3 million that's sold, and then we add on the cash. So at least 50 million. We can obviously leverage anything we acquire as well. So that's the type of the funding capacity that we feel we've got to invest. So a significant amount of money that we want to deploy. Third parties on new product development. Real reason or key underpin of that cash conversion KPI is that this is we will use operating cash and operating cash only to fund new product development, particularly if it's early stage like Orthros. Second bullet on there is we've probably I think we'd like, candidly, we'd probably like to invest a bit more in the pipeline over the last 5 years. So really focus on that. So we've probably invested 2 to 3% of our sales in that area, and what we're targeting there is an increase to something around 5%. So you'll start to see that, particularly through the CapEx line. I think Jenny mentioned we won't have a pipeline full of early stage assets where there's high risk, that before proof of concept. So key theme here is to make sure we've got a balanced pipeline of kind of early, middle and late stage assets. So that's what we're looking for there. On the dividend, so I think I touched on earlier, so we increased our dividend for the first time in about 3 years. So the focus really at the board meeting was on the total dividend of 5p rather than the final. So we can see on that right hand side that the cash cost of that is relatively small, about 0.4 million. The underpin of that increase was the trading performance, the balance sheet position before the sale of Identicare. As I said, we were into net cash anywhere on a normalised business basis. Strong levels of cash and clearly confidence in the future. Hopefully that you've heard throughout this presentation that we feel we're in a really good position now to kind of move forward. If you take, so there was 12 million returned to shareholder over the last 5 years, just a demonstration of the strong cash generation. In that same period, we reduced our debt by over 20 million. So the free cash flow of this business is really strong.
Thanks, Chris. Before we give a little summary at the end, it's probably worth going to questions now, if you're happy to do that.
Yes, of course. Jenny, Chris, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions, and you can do that just by using the Q&A tab, which is situated on the top right-hand corner of your screen. But just while Jenny and Chris take a few moments to review the questions that have been submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we have received questions throughout today's presentation. And Jenny and Chris, if I could just hand back to you just to read out the questions where appropriate to do so, and I'll pick up from you at the end.
Yeah, I'm just going to go through them in order because I think some of them we have been able to address. The first one was how much cash is currently on the books, and is the company looking to expand in Europe, Asia, or America? I think, as Chris has said, we're about 30-something million on cash, so that's the number there. And Europe is the priority. We're looking at Asia and the US, but not as the highest priority. But we'll keep our eye open. Next one, steps have been undertaken to increase margins or profitability. Again, I think I covered that in terms of rationalizing the portfolio and bringing in higher margin and more sustainable products. And inorganic strategies as well, yes. Yeah.
I was quickly add to, yeah. So if we look at the theme of kind of how the margins evolved, it's really around product mix. So from a gross margin perspective, I think there's a question later on. So we have a target of 60% gross margin. We think that's good in our industry. So that's where we're targeting, and that's gross margin. On EBITDA margin, obviously we've seen that that's relatively flat because of the overhead investment. But target wise, we're looking at 20% there. That will be more through leveraging the revenue line than accretion on gross margin. So hopefully that covers that area.
Okay, I think that's covered a few of them actually, so we should be okay. I think the next one was about the VHH opportunity, and we've talked about going into horses. It's a good opportunity. It's good for our size of the business, but also hopefully we may be able to get to launch quicker. And margin improvement, I think Chris covered that, but the segments that have been impacting this, actually it's impacted on all segments. We've seen margin improvement in all segments.
Yes. Yeah.
Percentage of sales coming from Daxocox and Plaqtiv in 23. How does the margin of these profile products differ from the other products? Chris, do you want to?
Yeah, so those combined are probably around 5% of revenues. How does the margin profile of these products differ from other products in the portfolio? So if you look at our average margin as 58, both of those are above that, and Daxocox well above that. So both very strong. Daxocox because it's novel, it's our own product, then that's a very high margin product.
I'm just checking that we've actually answered those. I think we probably have.
Yeah. So there's a question, what are the strategic initiatives that you see pushing both margin and sales? Will you look at inorganic strategies too? So I think we've covered that. So I think obviously there's all the work we're doing internally around the margins. And then as we've talked about, really from an inorganic perspective, I think I covered that on the capital allocation. That's really around driving the top line, the EBITDA and the operating cash generation. So accretive M&A is the absolute theme on that side.
Thank you.
Perfect.
I'm just going to comment. There's a comment which, thank you very much for making it. I'd just like to say it's great to finally see ANIMALCARE presenting to private investors. We recognise that we have been a bit remiss. I think it's also a function of the confidence we have in the business and the excitement that we have why we're here today. And so, really appreciate you joining. I really appreciate the questions, and thank you very much. I don't think there's...
No, Jenny, Chris, I think you've actually managed to answer all the questions from investors. And of course, the company can review all the questions submitted today, and we'll publish those responses on the Investor Meet Company platform. But just before redirecting investors, provide you with their feedback, which I know is particularly important to the company. Jenny, if you had any further closing comments, that'd be great.
Yeah, I'll just reflect a few closing comments. We delivered our revenue targets. We've increased sales across the products. We're continuing to focus the portfolio on those larger products that have better margins. Identicare was good news. It was strategically aligned with what we were trying to do. The same thing with the STEM piece. Orthros, early stage. If it happens, it will be really exciting. But if not, we'll do something else. We'll see how that goes, and we'll get more news over the next 18 months. And we will continue to look for profitable growth and cash generation. So we'll step up our investment in organic and inorganic opportunities where it makes sense. And now with the sale of Identicare and the divestment of our equity in STEM, we believe we've got the financial firepower we need. So I'd just like to reiterate my thanks to everybody for joining, and hopefully that's helped. And I'm sure if there are more questions, they'll flow through. So thank you very much, everyone.
Perfect. Jenny, Chris, thank you for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of ANIMALCARE Group PLC, we'd like to thank you for attending today's presentation, and good morning to you all.
Thank you very much.
Thank you.